I heard Ryan Dietrich, our friend at LPL, say this on his Market Signals podcast, that it's felt like we've been in a bear market for a lot longer than we have. 2022 has been a prolonged downturn, but that's all a bear market really means. That's the definition.
So if that's the definition and we are there, and we are, then where do we go from here? I think that's the critical question, Scott, is we've got to look at not that, getting all in the emotion, all in the feels of a bear market, but okay, where do we go from here? So what does history really tell us about this?
Yeah, so we've got a nice chart also provided to us by LPL Research. So if you're watching on our live stream, you'll be able to see that. We'll go over it as detailed as we can for our radio side and our podcast side. But stocks do tend to do well after entering into a bear market. So what you're looking at on the live stream is from 1950 till now, the number of times that we've entered a bear market and the date on the far left-hand column that they started. And then a little bit farther over where the color is, you'll see the S&P 500 index returns 3 months after we entered a bear market, 6 months after we entered a bear market, and 12 months after we entered a bear market. And
for people who aren't able to see this, I'm just going to tell you there's way more green on these returns than there is red. So positive than negative in those 3 and 6 and 12 month periods. Go ahead, Scott.
Yeah, there have been 10 instances that are measured here. So 3 months out, in 8 out of 10 of those instances, we were positive 3 months later. In 6 out of 10 of those instances, we were positive 6 months later. And 12 months out, in 7 out of 10 instances, we were positive. Now, let's dig down even deeper because those are good, encouraging numbers. The average gain 3 months later is 3.8%. The average gain 6 months later is 3.6%, and the average gain 12 months out is 14.8%.
Well, this means you just don't get off the horse until it quits bucking. That's what you basically do. You don't get out of a portfolio just because it went down. And the other thing that I want to talk about is that in the areas that you see that we did not go higher, when, there, for instance, if you take a look at 1970, we didn't go higher for 6 months, but we did for 12 months. But in 1973, we were down still 12 months later, 28%. In 2008, we were down still 29%. What does that mean? That means those times were times when the economy was just in shambles. It really was. You didn't know, whether we were going to come out of 2008, and the financial markets had all seized up, and none of that is happening right now.
Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.